Thank you so much for partnering with us, and we're excited to learn about budgeting.
Perfect. Thanks, Kylie. I really appreciate it.
Yeah.
Now, you guys will see that I am in kind of a strange place here. You may recognize it, you may not. I'm sitting in a motorhome where my family and I are in Moab, Utah. So we went out and hit the trails today, had a good time, and I wanted to come back and give you guys this class tonight to talk about budgeting. You know, it's definitely not a class that a lot of people have a tendency to want to join in and want to really review. It's interesting, as I've done my research, it says that anywhere from 8 to 14% of US citizens follow a budget on a monthly basis. So it's a pretty low number in my opinion. I know that as I've followed a budget, things have gone a little bit differently in our finances than when I'm not following a budget. And I'll talk a little bit about that tonight. Some ways in which we track finances, some way that my family does that, and mostly I'm going to share with you ideas on what we do to help our clients. And we do help them, of course, purchase homes. And so we find that a lot of clients have a tendency to do kind of a power budget at the beginning. They're really, you know, wanting to save money and possibly pay some debt off and everything. And so they're doing that very, very intently. They live very frugally at that very beginning stages to be able to save money for a down payment. And then after that, the budget kind of softens up. And so I think living within a budget is different times, different folds, different, you know, what that budget looks like. And so tonight I'm just going to share a bunch of ideas with you, and I hope that they resonate with you and that you are able to walk away with maybe a couple nuggets that may help you. One thing, just a little housekeeping, let you know, we will have different modules throughout this time. And I'm sorry that my camera shakes a little bit here. I'm trying not to do that. It's the table and motorhome and all of that. Anyway, I appreciate you guys being here. I'm just going to share my screen with you at this point. In between the modules, we will just open it up to questions. So if you can put your questions in the chat section down below, and then in between each section, I'll pause the PowerPoint, and at that point, you can ask your questions, and we'll go from there. So does that sound good, everybody? All right, thanks. So first here, and Kylie, you guys should see my PowerPoint, correct?
We can see it, yes.
Just to confirm, perfect. And one thing that you can do if you're not familiar with Zoom is switch to the speaker view on Zoom. That way, anytime that I'm sharing anything with you, the whole screen will then light up instead of just a little section there. So first of all, with my team, one thing that we look very, very intently with each client is we follow a three-step process with them. The first step is to be able to create mortgage options. We do that with comparing different options. We do that with a program that we call Mortgage Coach. We shared a lot of those programs, or we shared that program with you last time for those that were on the First Time Homebuyer Seminar, which we will have the First Time Homebuyer Seminar again in 30 days at the end of August. So we'd love to have you there. But ultimately, when we're going through and when we're talking to clients, when we're meeting with clients, we go through a three-stage process. That is, create mortgage options to be able to help them understand the true cost of money over time. We then go through what's called a total cost analysis. That will have typically four different loan options on there. It will go over payments, it will go over interest rates, it'll go over costs, it will go, and we'll really start to evaluate and find out what is the best option for you. And then the third option is really creating financial strategies and reducing debt. So I will tell you that our overall process takes, well, let me go into the next slide, and I'll go in a little bit depth on that. But ultimately, creating financial strategies to reduce debt, that takes around 22 years, to where a lot of our clients, we have them on a 22-year plan to where we can get them completely out of debt. And that would be buying a house today, looking at 30 years down the road. So as we have created mortgage options to be able to get you into a house, as we've gone through the total cost analysis, and now we're looking long-term, what I call the long game, the marathon, whatever you wish. But ultimately, we talk about 4 financial principles. And these financial principles are principles that we've learned from Dave Ramsey in following his approach. The first one is to be able to create a cash reserve, a 6-month cash reserve. With that 6-month cash reserve, it takes a little while to be able to accomplish that. But we're going to go in depth on some ways in which you can create a 6-month cash reserve. Second one is that we're going to help you pay off any non-preferred debt. So that would be auto loans, credit cards, student loans, any of those things. All of the non-preferred debt. The only preferred debt is a mortgage. And so that's the 3rd stage and the 4th stage. The 3rd stage is to be able to help you create significant liquidity. And I term significant liquidity as being able to have enough money in a bank account at the end of however long it may be. On average, it's around 22 years or so, 22 years, to where you've got enough money in that bank account to where you can physically write a check and pay your mortgage off. So the question is, do you do that? And that would be the 4th stage, which is you either pay off your house and you retire, or you let it ride for a little longer. Because remember the compound effects of money. It's one thing we're not going to talk a lot about today, but remember about the compound effects of money. Investors always taught us, invest when we're young, invest when we're in our 20s, right? And we can invest until 40 and then stop. And it would be just as we'll have a lot more money at that point than somebody that started at 40 and went all the way until they're 70, because that money grows and compounds. So I've made, I follow the rule of 72 in that, and I've kind of dumbed it down for me. But ultimately, the rule of 72 is that your money will grow and double over time, typically every 7 to 10 years, depending upon what interest rate you're achieving from that investment. So just remember that on the compound effects of money and paying off your house early and retiring early or being able to pay off your house early. So today we're going to have a discussion on how to create and stick to a budget, tools to protect yourself from hardships and manage financial crisis when they arise, understanding debt and how it affects your budget, and a plan for investing for the future. So the first thing that, as you're really starting to create a budget, the first thing is to be able to track your income and track your expenses. And so, and that sometimes is a hard step. So it's being able to successfully plan and understand your current financial situation. When you gain a better understanding of where your money is spent, you can better plan where you want it to go. And so with that, as you're tracking your expenses, first off, you want to know where your money goes each month. Second, do you feel in control where your money goes every month? Third, what challenges might you have in tracking your expenses? Write them down and how you overcome them. That is a really big thing. You want to come about a budget, and you want to, when you're tracking your expenses, you want to think about what are the things that are going to stop me from doing this. It's almost like you're starting a business, and whenever you start a business, you're always you start with creating the business plan. You create the business, you create it legally through an LLC or whatever, through legal documents, but you always have an exit strategy. With this, you want to look at that end, and you want to say, okay, what are the things that could stop me from overcoming, or the things that can stop me from tracking my expenses? Is it just, I don't have time, or I'll get lazy, whatever. Stay accountable to those things to where you will track them, and then track them until it becomes a habit. again, it's a difficult thing. And let me walk you through what we do. So right here is a personal family budget. Now, I just do our personal family budget through Excel, and we're tracking our income and we're tracking our expenses. And so there every month we have what the month, how much was owed minimum, total monthly paid, and then how it's saved. Now, one thing that I've done is I've got total month, or how much was owed. I have my total minimum monthly payment, and then I have my total amount that I paid, and then I have how much was saved. I also track my paychecks over here in number 5. So number 5, as I get paid, and at Waterstone Mortgage, it's kind of a screwy system, so I could end up with five paychecks in a month. I just, every time that we get paid, I put the paycheck down on here, so that way I know, okay, here's what my income was, here's what my expenses were, here's what I had at the end of the day. So does anybody have any questions on that? Let me see here. It doesn't look like it. I mean, it's pretty self-explanatory, right? Track your income, track your expenses. Not any rocket science there. So we're going to move on then if there's no questions. And if there's any questions, we pick them up on the next segment. So now as we start to create a budget, we're going to start to create a budget as to, we know what our income is, we know what our expenses are. We've tracked those for a couple of months. And now we're going to start to classify expenses as fixed expenses and variable expenses. Now, fixed expenses, of course, would be a mortgage or your rent, a car payment, maybe a personal loan that you have through, SoFi or something like that, installment loans that you have that do not become variable. And so a variable expense would be your electricity, if you guys pay electricity as you're renting, water, garbage, insurance, it would be your credit cards, it would be student loans, because it's variable, because as you're paying those things down, or as your electricity is going up or down, depending upon, if you have AC or if you have heating or whatnot during the winter. So, electricity has a tendency to go up and down. Those become variable expenses. So you track those. You track your fixed expenses. You know exactly how much your rent is every month. So you track that. If you have a car payment, exactly how much your car payment is, and so on and so forth. Also track any payments that you have that are 3 months, 6 months, or 12 months. So do you pay your insurance every 6 months? Track that. And so do you have any other payments that are on a quarterly or a half yearly or a 12-month basis? So track those. As you're going through, the old adage, you may find out that there's more month at the end, or there's more month at the end of your money, more money at the end of your month. Anyway, I'm not a good jokester today, sorry. But you may find out that there's more expenses than income at the end of the month, and you're really not alone. You can solve that in 2 different ways. One is make more money. 2 is spend less money. Or I guess there's a third way. I guess maybe there's even a 4th way. You could win the lottery, or you could put everything, on Black 32 in Las Vegas and maybe win it there. But ultimately, when you're creating a budget, you want to set realistic, motivating financial goals. And you want to pay off debt. When you're paying off debt, what I've found, and what a lot of our clients have found, is that the most motivating way to be able to pay off debt is not looking at interest rate. A lot of people have a tendency to look at interest rate, but instead look at your smallest debt. So let's say that you have 4 credit cards, and you have one credit card that's at $500, another credit card at $800, another one at $2,000, and another one at $3,500. Pay them off in that order. Pay off the $500 one first. Interest rate really becomes irrelevant because you're going to pay them off in a quick fashion. You're hoping to be able to do that, but ultimately pay as much as you can on that $500 credit card until it's paid off. Pay an extra $200 a month on it or $300 a month, whatever you can afford, do that. And once it's paid off, you're gonna feel really good inside. That's a motivating factor. If you try to pay that $3,500 one off first, then it's gonna take a long time to be able to do that. So pay off the small one first. And if you can pay off 2 of them in a month, that's huge. If you can pay off 3 of them in a month, that's huge. But pay off that smaller one first. Don't worry about interest rate. And then just take whatever you're paying towards that one, pay that towards the $800 credit card. Get that puppy paid off in a couple of months. Now go to the $2,000 credit card. It's going to take you a few months longer, but you've felt really good inside because you started with that small one, and it's a motivating financial, goals in that. So, and then really find and use a budgeting system that works for you. So Dave Ramsey's talked about the cash envelope approach, where if he says, we're going to set a budget of $100 a month on going out and eating or on entertainment or whatever, and so which in today's market and in today's time with COVID, it's a little more difficult. But ultimately, if you say that you're going to set a $100 budget to that, you take $100, put it in an envelope, and write on the outside that this is our entertainment money. And if you spend it in the first 2 days of the month, at that point you have no more entertainment money the rest of the month. You spend whatever it is in that envelope until it's spent. If you spend it in the last 2 days of the month, that's fine. You've had it in there. But ultimately, you go that month, you spend whatever's in your envelopes. So that's the envelope approach. I have a tendency to follow more of the digital approach. So I use Excel. And again, I do use really this personal family budget. And I can send this to you guys. So in that way you'll have a copy of it. There's a lot more down at the bottom of it, and it breaks everything down at the very bottom. It shows debts, it shows income, it shows what your minimum payments were, all of that. So let me see. I do see some questions coming through, and
thank you. I was just going to alert you to that.
Yep. So last but not least on the budget section, so I'll get to the questions here in a second, but on the budget aspect, hold yourself accountable. And one thing I would suggest is husband, wives, partners, single, whatever, hold yourself accountable. And so if you're married or dating or whatever type of relationship you're in, talk to one another and hold yourselves accountable. And so it's easier to do that. If you're single and, at the end of the day, there's savers and there's spenders. If you're a spender and if you're single and if you're having a hard time holding yourself accountable, then get an accountability buddy. So, just and talk to them, a good friend of yours, say, hey, I really want to start creating a budget and live by a budget. Is there any way you can help me do that? And if you're interested, I'd love to do the same thing for you. So, all right, let's get to the questions here. So we're done with that segment. Oops. All right. So, okay, let me go back to the expenses there. Now, Kylie, I only see one in here, and I thought there were 2 questions that came through. Maybe not.
I only saw one.
Perfect. Okay. So when you're looking at expenses, there's fixed expenses and there's variable expenses. So you want to classify your expenses as that. So you can get, very, very, very high tech with this, whatever, but ultimately up here at the top, a lot of these are going to be, your housing, your rent. Those are going to be definitely fixed expenses. I mean, if your rent's $1,500 a month, you know that it's $1,500 a month. There's nothing that's variable about that. Second is your auto loan. If you pay $300 a month on an auto loan, that's a fixed expense. If your student loans are a fixed expense, and they aren't going to go down at all, but they're a fixed expense, as an installment loan, that would be a fixed expense. If you are contributing $100 a month towards retirement, that would be a fixed expense. You know what that is on a monthly basis. Any credit cards would be a variable expense, because as you pay the credit cards, your minimum monthly payment is going to drop. Also, electricity, gas, your phone, water, sewer if you pay those, garbage if you pay those, dry cleaning, any of those things are going to be variable expenses, because those are going to change on a monthly basis. I mean, dry cleaning, you may say, I'm not going to have my dry cleaning done this month. That becomes very variable. So I hope that answers that question. Perfect. All right, so let's run through here. So financial principles and skills. Again, I mean, this is really working at that balancing a budget and everything, and that is really work and take responsibility. Budgeting, I'm going to tell you why probably on the high side, 14% of U.S. citizens create a budget and use a budget on a monthly basis or a yearly basis, because it's hard. It's very, very hard. And so successful people create a budget and they work off of a budget. It doesn't matter how much money you make. If you are on low income, creating a budget, or if you're, you make a lot of money, creating a budget. You may think that you may not need to create a budget when you make a lot of money, but you have goals, and really all the budget does is to be able to help you to get to those goals. So again, as I've already talked, work together to manage money. If you're in a partnership, if you're married, if you're single, find a buddy to do that with, and then really hold regular, I call them family meetings, but really hold regular meetings to discuss money and debt with whoever you've partnered up with. So I want to talk a little bit about protecting your family from hardship. And so as we protect our family from hardship, there's really 3 ways to be able to do that. First is we create that, instead of a 6-month emergency fund, as what we do with our clients, we call it the marathon approach. Everything that we're doing here, and as I went through the 4 financial principles that we share with all of our clients and that we work with our clients on, I didn't tell you how we get there. Really, this is a marathon approach. This is, if somebody's getting ready to run a marathon, they don't just run 26 plus miles in one day and say, okay, great, I'm ready for tomorrow, I'm ready for the marathon. No, they train, they consistently train, they work their bodies, they consistently do that, but they run 2 miles, and then 3 miles, and then 5 miles, and then 10 miles. And then the day that they're running, they don't just get there and say, all right, great, I'm going to hit it on the 26 miles. I can envision myself in crossing that, crossing the finish line there. No, they're saying, okay, I'm gonna run 1 mile, and I'm gonna run another mile. I can remember when I was young, I was about 14 years old, and scouting, I was a Boy Scout, and I remember we went on a 50-mile hike trip. It turned into 63 miles, not quite 50 miles, but it was turned into 63 miles. It was a lot of fun. I was all of maybe 120 pounds or whatever I was. and my pack weighed 65 pounds. And so my pack was the heaviest pack on the first day, that when we all started. My pack was even heavier than the leaders' packs were, and a lot of them had supplies and stuff that they had to pack for us that would forget stuff. But ultimately, the way that I got down that road, the way that I got down that path is the same way that a marathon runner does, the same way that a football team does. And that is, they just say, all right, I'm going to go here, I'm going to cross that line, and then I'm going to cross another line. And so, you know, for me, it was, I'm going to go all the way down to where that tree is, and I'm going to stop for a break. And so I went down there, and then I thought, no, I'm going to go to the next tree. And I could see that tree. And it's the same thing here, is you don't just all of a sudden wake up and boom, I have 6 months cash reserves. No, it takes a while. And so we're going to help. And literally the way that we do the 4 financial principles is we meet with our clients every year. We talk to them. We have a financial review, a mortgage review with them every year, where we look at their mortgage, we look at their 6 month cash reserves, we look at any debt that they may have. We look to see how they're doing with significant liquidity. We look to see how we're doing to be able to pay that debt off, because we're extremely good. And if we're blessed to be able to help you guys, you will find out that we're extremely good at helping you get in debt. We want to help you get out of debt as quickly as possible. So here is, you know, that football team that's saying, I just need to get 10 yards down the road. So here is the first thing to protect your family from a hardship is, don't worry about a 6 month reserve yet. Just get a 1 month reserve. So before you pay any debt off, before you do any of that, start with a 1 month reserve. Track your expenses, track your income, do that. So do that for a few months. Don't worry about paying any debt off. Start saving money, but create a 1 month emergency fund. Those, if any of you have been affected by COVID with the loss of a job, you'll know how important that 1 month emergency fund has been. And so, and I pray that none of you have, but ultimately it's hugely important. And then as you grow that, now we start to pay off debt, and then we'll pay off some debt, and then we're going to start to grow a 3 month reserve account, and then a 6 month. Also, one thing that we want to look at is, do we have adequate insurance? And so with insurance, there's multiple different types of insurance. We'll talk about that here in a minute. But ultimately, do you have adequate insurance? Don't forget, you should have renter's insurance right now. So should somebody break into your building or into your location and steal the stuff in your place, or should your stuff burn down, then your stuff can be replaced. And that your landlord has insurance on the building, but they don't have insurance on the interior of your space, and so on your personal belongings. And that renter's insurance is dirt cheap. I mean, it's like $15, $20 a month. So as you have reserves, as you're starting to create those reserves, so you should work to build a 1 month reserve fund as fast as possible. Put extra money towards your emergency fund until it's complete. Even if you have debt, make only the minimum monthly payments to be, and do that until you have that 1 month reserve. Some people, to speed up the process, they've gotten, you know, they've taken overtime, they've gotten bonuses, they've done a lot of things. You know, you may need to maybe sell some things if you want to accomplish that quicker, or live without for a little bit. But again, you know, a lot of people have worked overtime and different things to be able to help get there a little quicker. For insurance, how would your family, should you have a family at this point, and so how would they financially be able to move forward if you became ill or disabled, or perhaps passed away? And so what would that impact look like for your family? Maybe if you were in a car accident. So if you're not prepared, if we're not prepared, they can cause major financial problems. And so a good source of protection against a financial hardship is insurance. And so really start looking at 4 different types of key insurance. Property insurance, which If you own a home, then you have homeowners insurance. And there's a lot of other things that come from that homeowners insurance, but ultimately health insurance. And so we all have to have health insurance now, but health insurance, and then life insurance. So heaven forbid something happened to you, your family's taken care of. What I tell a lot of people is you can have enough life insurance to be able to pay that mortgage off if you want. It depends upon how old you are and different things, but really look to a life insurance expert to know how much life insurance you should have. And then disability insurance. So if you're in a car accident and you're disabled for a little bit, what type of insurance? And there's other types of insurance like Aflac and different things like that may be good resources. But look into those and see what would be the best for you. And so really understanding debt. As we're looking at debt, it's really money that you've borrowed that's not yours, and it comes at a cost. And a lot of times that cost can be pretty significant. It's interest. And so you end up paying much more than on debt, on a credit card and whatnot, than what you originally paid for that item. And so the idea is that as we're creating reserve accounts, 1 month reserve and whatnot, a lot of people, a lot of times we've gone into debt because we've had a financial problem that's came up or whatnot. So your reserves allow you to be able to not use your debt anymore, but ultimately use your reserves. So you buy a house and your hot water heater breaks. At that point, instead of going into $600, $700, $800 worth of debt for a new water heater and a plumber to come out and install it, you can just pay that out of your reserves and then rebuild your reserves instead of having to use debt. So getting out of debt, you definitely can get out of debt. It takes a lot of discipline, and that. And so there's 5 important principles of getting out of debt. First one is understand your debt realities. So again, as you've tracked your income and you've tracked your expenses, your debt realities really start to come into play because you know exactly how much debt you have and where it is. Desire to get out of debt, that's the second stage. Desire to get out of debt, that's the third stage. So you've got to have a desire to get out of debt. And then the fourth one is stop incurring debt. So you've got that month reserve, and then start to pay off your debt once you get that 1 month reserve. So don't do that until you have the 1 month reserve. Now you can stop incurring that debt. And if you're living beyond your means, then that's a hard thing to sometimes break. So really work hard to be able to break that. Again, use your accountability partner. And then pay off debts one by one. Again, the long game, I've already talked to you about the marathon and all the different analogies that I used. Whatever works best for you. Ultimately, just remember it's a long game. If you happen to get in a little more debt as you're going along, it's okay. Just work harder to be able to get out of that debt. And then desire to get out of debt. In order to do anything difficult, including getting out of debt, your desire must be stronger than the obstacles. And so one thing that a lot of people have is they have impulse buying or emotional buying, emotional spending. So again, that's why it's important to have a accountability partner to be able to help you through this. So that way, if emotional spending starts to come into play or impulse buying or whatnot, then it's you can just call your accountability partner. People I've heard before, they've taken their credit cards and put them in a block of water or in a thing of water and put that water in their freezer, and they've frozen their credit cards to where you have to work to get to them. If that's a way to be able to do that, then whatever works for you. If you need to put your credit cards in a safe deposit box to where you have to go to the bank to pull them out, again, whatever works for you. So again, you want to build that emergency fund, then a 3 months, then a 6 months, and then use this money when needed instead of using your debt. So, and then paying off debt, start with the smallest and then work your way up. Again, I can't stress that enough. It's really there's two reasons for it. As you're paying off debt, you start with the smallest account. A lot of people will say, no, start with the highest interest rate account. Well, let's just say that in the analogy that I gave you before, 500, 800, 2,000, and 3,500, let's say that $3,500 was your highest interest rate account. Well, if you started with that, it's going to take you a while. It could take you a while to be able to pay that off. So if it takes you a while to pay something off, you can lose interest. And so that's the way that we're wired. That's the way that we are. So do the smallest one first. And it doesn't matter if it's the lowest interest rate. Do the smallest one first. I can't stress that enough, because as you pay that off, those endorphins kick in and you feel really good about yourself. Then move on to the next credit card. So managing during financial crisis, again, you do that through creating a 2-month reserve, a 3-month reserve, a 1-month reserve, then you go to 2 and 3 months, and then all the way to 6 months. But in between that first month and going forward, you're starting to pay off some debt. So, and what I would suggest on that is get your 1-month reserve account first, and then put some money towards building, let's just say that you've budgeted $300 a month to be able to pay off debt. At that point, maybe take $100 a month, put it into your reserve account every month to where that money is going to grow. And then the other $200 pay off your debt. And so where you're starting to do both of them at once. And then as you're starting to go forward, really investing for the future, that's going to be key. And so you do that in 4 areas. So you save money, you purchase a house, follow the 4 steps that we put into play, and then always keep learning. And again, those 4 steps that we go over are the 4 financial principles with a client. So 6 months reserve, we become your accountability partner at that point. We also become your accountability partner to be able to help you pay off your non-preferred debt, to be able to create significant liquidity. Now, I will tell you that what a lot of people are doing right now, and to be able to springboard this, is in purchasing a house. Purchasing a house is a big step. It's a really big step, and it's a huge step for a lot of people and for most people. So with that step, as you buy a house, your house is continually growing in equity. Right now, it's about 5%, 6% per year. And what we're helping a lot of clients do is they've gotten into a little bit of debt over the last little bit, and they may not have all their 6-month reserves. Maybe they have 2 months reserves or 3 months reserves, but they don't have the full 6 months, and they've got some debt. And so what we do is we have an opportunity to be able to refinance them in times like this when interest rates have dropped significantly. And so we can end up helping actually to be able to progress to where we can help with all 3 aspects and just a refinance. And with that, we can pay off debt. We can help create an account with 6 months reserves. We can then help create an account starting with significant liquidity that's going to grow and double over time. And so we look at a lot of different financial planning tools to be able to see what makes the most sense. Now, again, anytime that you're looking at a house purchase, the first step is just to buy that house. And that's the biggest step. And so from there, as we're starting to follow the 4-step plan that we've put in place, with that then we're really looking at suitability. And suitability is a financial planning term. And so suitability also basically just means that, are we putting you into the right plan? And so there's investors and there's spenders. And so if we gave you $100,000 today because we refinanced your house and we've given you $100,000, we've paid off your debt and everything else, are you a spender or are you a saver? And so if I came back to you in 6 months from now or a year from now or 3 years from now and said, hey, I've got a great investment for you. Can you invest that $100,000 here? An investor will have that money there. A spender, they've already spent it. So we will look at and we will adjust the financial plan as to what you are, saver or spender. And so if you're a spender, then we're going to take that $100,000 and we're not going to pull it out of the house, but we're going to help you accelerate your mortgage even faster to where you can get your mortgage paid off even faster. And so again, there's a lot of different areas that we're looking at here. The first step is track your expenses. And so it's harder than it sounds. And so, but track your expenses. You can do that through a digital plan or a cash envelope plan, whatever plan you want. And it can be, I like Excel, but it can be, you know, digital. I mean, you could go buy QuickBooks and use QuickBooks on a personal basis. That will key up to your bank account and whatnot. It could be that. The cash envelope approach I know works. I've had friends that have used it and clients that have used it. It works. And so, and it's really a cheap way of doing things. I mean, you go buy $10 worth of envelopes and you already have a pen laying around. If not, I can send you one. But ultimately, just write on the outside of the envelope, rent, put the cash in there, or, you know, pay it out of your account, but you know that, you know, you had it in the envelope there. And so, meaning you have a fictitious $1,500 in that envelope. Maybe just write a, you know, $1,500 deposit or whatever. But anyway, you have what your budgets are on the envelope. You then pay those things. So track your expenses, income, start to create a budget, start to create those cash reserves. You're looking at insurance to be able to protect your family long term. As you start to create those reserves and paying off debt, you want to be able to manage financial crisis, and you do that by way of creating a 3-month and a 6-month cash reserve to be able to do there, to get to there. So, and yes, I will, what I'll do here, I'm on vacation right now. And so for those of you that didn't hear, I'm in Moab right now, on vacation with my family here in a motorhome. We rented a motorhome and we're putzing around with that. So, so what I'll do is next week when I'm back in the office, everybody that signed up, I will send you guys the Excel spreadsheet that I use, and I hope that that helps. So are there any other questions, guys, that you guys have? I've really tried to make this as self-explanatory as possible. It's budgeting. The only difficult thing with budgeting is just doing it. It's the discipline of doing it. And so that's the difficult side. And that's why you want to have an accountability partner. And so the actual doing it is really not that hard. I mean, it's very simple to be able to put down on a, you know, if you write it down on a piece of paper, it's easy to be able to track your expenses, track your income. I mean, those things are just really, really simple. But you've got to put your income and expenses somewhere, track them somewhere to where you can see them and you can see them all. And then, you know, I've got a yearly long budget deal that I'm working on. So to where I can just see, you know, a couple months ago what we spent exactly, and it's a quick reference for me. So I really hope that this has helped. And let's see, what the initial cost of getting into a house would you be coming from? So, and it, you know, when you're buying a house, what I would do is, and this is to answer your question, Ethan, is I would have my 1-month reserve, and then from there, I would start to save money. You and I can talk on a one-on-one basis and create a personal plan for you, looking at debt and everything else. And so when you're buying a house, really the reality is with the housing market that we're going to be in for the next while, you want to be able to get into a house as quickly as possible. And so, you know, with that, you want, and really the reason for that is if houses are going up at 5% per year, and you buy a $300,000 house for just round numbers, $300,000 house, and it's going up 5% per year, that means that you're making an extra $15,000 a year, and you're paying principal towards your mortgage, and you're paying your mortgage down every month. And so we can start to springboard a lot of what we're talking about with, paying off debt and everything else through the purchase of a house, and that. But ultimately, yeah, I mean, I would create your 1 month reserve. In the meantime, let's talk, and let's start to create a personal plan. But ultimately, create a 1 month reserve and start saving money after that for your down payment. Don't worry about paying off your debt unless we then look at it and say, well, you've got to pay down these debts or whatnot to be able to qualify. So I hope that helps. But then once you buy the house, once you're in the house, then you're starting to create that 6 month and 3 and 6 month reserve. So great question. All right, guys. Perfect. Well, thanks, guys. Again, thank you so much for the opportunity to chat with you guys about these, about these things. I really hope that you attend our next class, which I'll just tell you here is, it's in August 25th, if I'm not mistaken. And so August 25th, which is a first-time homebuyer seminar, where we're going to talk about different loans and really the different loans that could work for you. So a lot of people make the misconception that you have to have thousands and thousands and thousands of dollars to be able to buy a house. You really don't. You need your down payment money, and there's even some loans that we have that don't even require down payment money. So and then the closing cost money can come from the seller. So we'll talk more about that in the first time homebuyer class. If you have any questions between now and then, please reach out. And so you'll have my email address when I send out the Excel spreadsheet next week. Again, thank you so much. Kylie, thank you so much for setting this up. We really, I really appreciate it. I can tell you that when you're talking about landlords, really Neighborly Ventures is one of the best landlords out there. What other landlord has set up a program to where you can talk to somebody about budgeting, you can talk to somebody about buying a house. They really they have their best interest in mind for you. So they want you to be able to grow and succeed, and to be able to continually do well. So thank you. And thank you, Kylie. And I'll give it back to you.
Oh, that was really kind. Thank you so much. Thanks to all the residents who joined and some employees too. Thanks, Walt. That was great. I'm actually really inspired. I was taking notes along the way, so I'm gonna probably bug my husband and make him look at our budget when we're done. So everybody have a good evening, and thanks for joining us. We'll see you next time.
See ya.
Bye.